Welcome back. Today we're diving into Egypt's economic agenda for 2025-2026. And there's one number that really jumps out.
You mean the $42 billion target for net foreign direct investment?
Exactly, $42 billion. It's huge. You really need to understand what's behind that figure.
It is monumental, especially when you compare it to the, what was it, $11 million forecast for the previous year? That's nearly 4 times higher.
Right, so that kind of leap,
Yeah.
it makes you wonder, how is that even possible? It can't just be, normal business growth.
No, absolutely not. And that's the immediate takeaway for you, the listener. This isn't about a sudden boom in, say, building new factories, the usual greenfield investment.
Okay, so if it's not that organic growth, what is the mechanism then? Where's the $42 billion actually coming from?
The bulk of it is planned to come from what we call non-organic flows.
Non-organic, meaning?
Meaning large-scale asset sales, privatization deals, strategic transfers of ownership, stuff like that.
Yeah.
And the main vehicle managing this is TSFE, the Sovereign Fund of Egypt. They're tasked with handling these big strategic deals.
Wait, let me get this low. This massive $42 billion target. It's less about building new sustainable industry for the long term and more about essentially selling off existing assets to bring in cash, like a major push to stabilize foreign reserves.
That's a big part of it, yes. You could see it as a pragmatic, maybe necessary step given the current pressures.
Okay, makes sense. But were there any areas where traditional investment actually did well?
Yes, there was one notable success story. Renewable energy. We saw some significant investment there.
How significant are we talking?
Well, over $420 million just in the manufacturing side, plus major projects involving big international names like Siemens Gamesa, Scatec, big players.
That does sound like a genuine win. Attracting global firms, building capacity.
It does, but there's a crucial detail, a bit of an asterisk, you could say.
Okay, what's the catch?
The reason these big players came in wasn't just faith in the market itself. It was heavily supported by specific risk mitigation tools.
Such as?
Long-term power purchase agreements, or PPAs. And here's the key. These PPAs were sovereign guaranteed and critically denominated in U.S. dollars.
Ah, the USD guarantee. So investors were protected against currency risk.
Precisely. That dollar guarantee provided the security they needed. It reduced their risk significantly.
So a success, but a conditional one, heavily reliant on government backing. Let's contrast that with something meant to boost investment across the board. The golden license. That was supposed to be the magic bullet for cutting red tape, right?
Yeah, the single approval mechanism was widely advertised, but, well, it seems to have largely fallen flat. It just didn't deliver what was expected.
Why not? What went wrong?
It boils down to the eligibility criteria. They were simply too restrictive.
How so?
Well, they put in rules like requiring the company's issued capital to be at least 20% of the total project costs, and strict conditions about securing foreign currency, either through exports or foreign financing.
20% upfront capital. That sounds like it would exclude a lot of businesses.
Exactly. It essentially put up a sign saying only large, cash-rich companies need apply, especially those who could guarantee bringing in hard currency.
So instead of a tool to genuinely streamline things for everyone, GFI, the investment authority, kind of turned it into a gatekeeper, focused only on getting those dollars in the door from big players.
That's how it seems to have played out, yes. Securing hard currency liquidity became the priority over broad-based business environment improvement.
Okay, so the regulatory reforms are struggling, partly because of this underlying pressure for foreign currency, which brings us to the macroeconomic elephant in the room. There are some serious risks hanging over all this.
There certainly are. Look at the budget deficit. It's projected to nearly double, hitting around 7.2% of GDP in fiscal year 25.
Wow, 7.2%. That doesn't leave much room for the government to offer financial help or incentives, does it?
Very little room. And then there's another figure you need to watch closely. Contingent liabilities.
Those are the implicit government guarantees, right? Like the ones backing those renewable energy deals.
Exactly. And those have climbed to 34.0% of GDP.
34%. Just to put that in perspective for everyone listening, if those implicit guarantees were all called in, the national debt effectively jumps by a third.
It's a significant potential liability, and it highlights the paradox. The most successful organic investment projects, like renewables, are also the ones increasing the state's financial exposure because of those guarantees.
Real double-edged sword. Okay, so we have asset sales driving the headline number, restrictive reforms on the ground, and big macro pressures. Is there anything else holding back long-term investors?
There's one more structural piece, often overlooked, the exit barrier.
The exit barrier. You mean getting out of an investment?
Precisely.
Yeah.
While they've worked on making it easier to start a business, easing market entry, the process for closing one down, things like corporate liquidation and bankruptcy, remains quite complex and slow. Protracted, really.
So it's like they built a really fast, easy front door, but the back door, the fire escape, is still narrow and hard to get through.
That's a pretty good analogy, actually. So you end up with this sort of two-speed approach.
Right.
You've got the fast track, necessary asset sales managed by TSFE to get that $42 billion. Right. And then the slow track, the more fundamental business reforms under JFI, which are still quite restricted.
So the bottom line for you listening is hitting that $42 billion target is primarily about selling assets, not necessarily a sign that the underlying climate for all businesses is fundamentally fixed. Not yet, anyway.
Correct. It's a monetization strategy first and foremost.
Which leaves us with a final thought, something for you to consider. What really signals long-term confidence to a global investor? Is it just how fast they can get in? Or is it knowing there's a clear, predictable, and reasonably efficient way to get out if things don't work out?
That's a crucial point.
Maybe tackling that exit challenge, making bankruptcy and liquidation smoother, is the next big step needed for truly deep structural reform that builds lasting investor trust. Something to keep an eye on.